Thank you for joining me today on this episode of the Simply Financial Podcast. I'm your host, Christopher Calandra, and I want to increase your financial IQ with today's episode. Today's episode is the second in a three-part series that I'm doing on the major market indexes. This is the second part. I strongly encourage you to listen to the previous episode, but the thesis is the following. You turn on the news, you log into your computer, and it says the Dow is up X, the S&P 500 is up Y, and the NASDAQ might be down such and such. So you might be familiar with the Dow, S&P 500, NASDAQ, but how familiar are you really with these indexes, which are incredibly important? The purpose of this quick three-part series is to cover the basics of what these indexes are and also give a little bit of a historical perspective. As I said, in the previous episode, we covered the Dow, which is the Dow Jones Industrial Average. That's the formal name. It goes by Dow for shorthand. And today I want to cover the S&P 500. The S&P 500 is widely considered the most accurate gauge of overall U.S. market. It's run by the Standard & Poor's company. It's changed its name over the years, but it's basically a financial research and intelligence company. The S&P 500 consists of the largest 500 companies in the United States based on market capitalization. As I described in the previous episode, market capitalization is take the stock price and multiply it by the number of shares that are outstanding, that are for sale or owned in the marketplace. And you multiply those two numbers together and you come up with market capitalization. So the largest 500 companies in the United States makes up the S&P 500. Sort of makes sense, doesn't it? Incredibly, the S&P 500 covers 80% of the total available market value. There are other companies that comprise the total stock market, but 80% of them fall under the coverage of the S&P 500. So that is why it's the most accurate gauge of overall U.S. market health. You not only have to be large to be included in the S&P 500. I believe the break-off point is around $15 billion of market capitalization. But the S&P also have other criteria to have a company included in the S&P 500. Some of those are liquidity. The companies have to have enough liquidity, meaning it's relatively easy to buy and sell the shares. And so you need to meet that liquidity threshold for inclusion. There's also an earnings history metric that needs to be met. In other words, if there's a large company, but they've never had any earnings, they will not be included in the S&P 500 regardless of size. The last example I'll give is the company needs to be US based to be included in the S&P 500 index. There are others, but those are three examples. The S&P 500, like the Dow, is not static. Companies come and go in and out of the S&P 500. Companies get larger, so they move up the rankings in size and importance in the S&P 500. Companies will merge. So then the merged company will be bigger and count more in the S&P 500. That then would open up a spot in the S&P 500. We do an analysis to figure out what company should be now included to round out the list. Sometimes companies get too small and they drop off the list. They might go out of business and drop off the list. They could move to overseas domicile. That would move them off the list. The S&P 500 is not static. If you look at the companies that comprise the S&P 500 today, it's different than it was 10 years, 20 years, 30 years, 40 years ago. It has changed. It's changed a lot as U.S. industry, technology, the world has changed dramatically over these many years. The S&P 500's complexion has changed too. As an example, there used to be a lot of railroad companies. Not nearly as many railroad companies. There used to be more manufacturing companies in the 50s, 60s, and 70s. There are still manufacturing companies today, but less important than they were a generation or two ago. Here's an interesting piece of historical tidbit. The S&P 500 was started in 1957. It's probably worth mentioning that there was a precursor that had begun in the 1920s, and the S&P 500 was sort of built on top of that previous analysis. But it was started in 1957, and when it opened, it was at 44.06. So it was 44.06. So the wild historical tidbit is, as of this recording, the S&P is at 7,100 and change. We've gone over the years from 44 to over 7,100. And that reinforces what you probably know. The stock market over time has been a wonderful creator of wealth, providing terrific returns over the long term. Of course, that's punctuated by down periods, bear markets, times when the market went down. But if you look at the long-term performance of the S&P 500 from 1957 until today, the numbers are awesome. And going from 44 as a starting point to 7,100 today just brings that point home even more strongly. So we covered the S&P 500. In the previous episode, we covered the Dow. In the next episode, I will cover the NASDAQ. I hope you listen to all 3 episodes. I also hope that you check out our website, elliottwealth.com. And lastly, if you haven't subscribed to the show, the Simply Financial Podcast, please do so. I'll be back with you on the next episode where I fill you in on the third of the 3-part series on the indexes. I'll be back with you very soon to give you that information. Thanks for listening today.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.